Yeah, good morning, Cheryl. My sense is, Cheryl, these kind of global events are now something which most retail investors have got to get used to. This is a normal occupational hazard in the markets. But I think the clear focus of retail investors should be to have a more disciplined approach to investments. Please remember that only in these panic times you get quality businesses at good prices. So I think one has to look at good quality, well-managed companies, very strong balance sheet companies in these kind of troubled times, and actually do a kind of SIP for a longer period of time. I'm not surprised that once the market digests this news, every day in the market is a new day, and I think the market bounces back with renewed vigor and enthusiasm. So I think keep the focus long term and always try to remember pick up quality stocks when the going is bad. That actually will generate a very good alpha if the investor has a horizon of at least 3 to 5 years. Cheryl, we can continue to hold on. See, Kalpataru Power is a very large player in the power, transmission space. It's got a very large EPC order book, and I think recently the company has got significantly large orders which are expected to be executed over the next say 12 to 18 months. So I think if the investor has a medium-term horizon, at least minimum 12 to 15 months, I think he should hold on. This is a quality play, and I think with the interest in the power generation sector, even power transmission companies like Kalpataru should do well. So continue to hold on. I think probably you'll have to wait for the next 12 to 15 months to get a decent risk reward. Yeah, I think clearly for long-term horizon, Shrishti, the company definitely looks interesting. I think there's a lot of interest in power generation, and I think my sense is that over the next say couple of years, if the investor has a kind of time frame where he wants to build a portfolio, he could definitely look at buying the stock on every decline. We believe that earnings trajectory over the next couple of years should be pretty solid. So to that extent, I think he can definitely nimble at the current price, but keep a time frame of at least 18 to 24 months. I think Cheryl, if the investor has at least 2 years in mind, he can definitely look at investing in IRFC because see, basically for IRFC, Indian Railways is the only customer, and almost 40% of the railway capex is funded by them. Most importantly, IRFC is more of a dividend play rather than a growth play because the dividend yield is much better than a normal fixed deposit. So I think investors who want to play safe and want to get steady returns, say over the next say 18 to 24 months, could definitely look at accumulating at the current level. Biocon has disappointed investors. In the last quarter, there was a exceptional loss by which the company incurred net loss on the bottom line. My sense is, if the investor doesn't have a long-term view, then I think he should definitely exit. But a better option could be Sun Pharma. I believe that Sun Pharma is far more better positioned compared to Glenmark, and that is because their specialty product portfolio is now doing pretty well, and even from these levels, one could expect a decent 15 to 18% upside here. So I think if at all he wants to switch, Sun Pharma could be a better bet at the current levels. Shrishti, from a long-term point of view, at least the next 2 to 3 years, IDFC First Bank has managed to generate a very strong CASA deposit of almost 50% plus ever since it got converted into a proper full-fledged bank. Most importantly, it focuses on the SME and the MSME sector where the management commentary post the Q3 numbers have been extremely positive. My sense is, if the investor has at least 2 years plus kind of horizon, he can even accumulate at the current level. And one interesting development which has happened is IDFC, their parent, has actually invested about 2,000 crores plus currently to maintain their stake in the bank. So which clearly shows that the promoter itself has got a lot of positivity and confidence in the bank. So I think keep a time horizon of at least 2 years plus, and I think one can even nimble at the current level. Sharil, since he's up by almost 98% on his investment, my suggestion is that you should always follow a margin of safety strategy. He should obviously book out some quantity, recover his capital, and hold the rest quantity for the next 2 years. See, the railway infra space is a very large opportunity. In the current budget, the investment in railways, which was announced, was about 2,40,000 crores, and RVNL is already sitting on an order book of almost 4,000 crores plus. So order book is going to give them strong revenue visibility. So I think hold on to the rest quantity, and at least 20 to 25% of his holding, if he can book out, he could obviously make all his shares completely free of cost. So that takes out the volatility in his investment, and at the same time he enjoys his capital has already been recovered. So I think partly one can book out and partly one can hold for the next 2 years. Shrishti, I think he can definitely add more at the current level. Considering the HDFC Bank and HDFC merger, I think the key reason for this stock to underperform is basically because until the merger doesn't go through, there's a lot of uncertainty on the combined entity. Most importantly, in the budget, there was an increase in the tax dues for premiums paid over 5 lakh rupees. So I think that also has contributed to some underperformance in most of the insurance companies, including HDFC Life. So I think keeping a 2 year view, I think one can definitely expect some decent outperformance here. The company is a market leader in the insurance space. And my sense is that you need to have a little more patience in this stock. It has underperformed, so I think keep a time frame of 2 years plus and stay invested here. No, I think this stock underperformed significantly in the last, say, 2 to 3 quarters. So my sense is, the entire media space history has underperformed. If you look at performances of the other large leading players, my sense is that, looking at the kind of cutback in budgets by the FMCG kind of segment, most media companies have underperformed. TV18, my sense is, unless, the investor has a long-term view, at least 2 to 3 years, I would not be surprised that in the short term, there could be very few triggers for this stock to get re-rated. So in the near term, if the investor is not interested to hold for the next 2 to 3 years, he could look at other promising sectors like capital goods, auto components, where the risk reward and the earnings visibility of these companies, within these sectors is much better. So I think a switch may sound better. TV18 is unlikely to move up in the near term.